Imagine borrowing money for your business, but instead of paying it back with cash, you pay with a piece of your company, sometimes instantly doubling your growth potential. That's the unconventional power behind a convertible loan, and it's changing the way startups get funded. Why would a company choose a convertible loan over a regular bank loan or even venture capital? The answer lies in speed, flexibility, and the unique advantage of skipping a stressful company valuation. With a convertible loan, businesses receive cash fast, and the catch is simple: the loan turns into company shares at a future date, often during the next big funding round. Does that mean the founders lose control immediately? Not quite. Convertible loans start as traditional loans, only converting into equity when a certain event happens. Think of it like a financial switch that flips at just the right moment. If the company never hits that milestone, the loan can still be repaid the old-fashioned way. How does this benefit investors? They get the security of a loan with the upside of equity. When the loan converts, they often buy shares at a discount, sometimes 20% or more below market price. That's like getting a VIP pass to the company's future success before others even line up at the door. Is there a downside for founders? Share dilution is real. When the loan converts, investors own a chunk of the company. The more money borrowed this way, the bigger the piece they receive. It's a balancing act, fueling growth quickly, but being mindful that every dollar borrowed now could mean less ownership later. Why are convertible loans exploding in popularity with startups? Traditional venture capital can be slow, with months spent negotiating valuations and deal terms. Convertible loans cut through the red tape, offering a simpler contract and fewer legal hurdles. Startups can bridge critical funding gaps, keeping momentum while waiting for the perfect investment round. What about the terms? Are they risky? Convertible loans often set a valuation cap, ensuring investors convert at a favorable rate if the company's value soars. There's also an interest rate, but it's usually modest, think 2 to 8%. If the trigger event doesn't happen, the company repays just like with any other loan. Who should seriously consider this approach? Early-stage companies without a clear valuation, those chasing rapid growth, or anyone needing to move fast when opportunity knocks. But even mature businesses have used convertible loans to avoid giving up too much too soon. What's an everyday example? Picture a bakery launching a new product. Instead of taking a bank loan and worrying about monthly payments, the owner takes a convertible loan from a supportive investor. If the new pastry is a hit and the bakery grows, the investor gets a slice of the business, not just their money back. Are there alternatives? Sure, traditional loans and equity rounds are always options, but neither offers the unique blend of speed, flexibility, and investor incentive that convertible loans deliver. They're not the right fit for every business, but for many, they're the secret ingredient to scaling up quickly. Because understanding how creative funding can transform business growth is just the beginning. The next video reveals how a 502 loan could unlock homeownership in ways you never imagined, especially if you thought it was out of reach.